Something simply collapsed in the silver market, and I mean simply collapsed within the last hour. Right now, as I record this on Monday, February 16th, 2026, silver is trading at levels that have every serious trader I know sitting upright in their chairs, checking their positions, recalculating their risk. The price action today is telling a story that most people won't understand until it's too late. But if you're monitoring this video right now, you're about to be ahead of 99% of the market. Because what I'm seeing in the data isn't simply noteworthy, it's crucial. Silver shut last week at approximately $82 per ounce. Today, Monday morning in Asia, it opened at fresh 2026 lows, dropping to $74.90 per kilogram in India, which translates to roughly $77 to $78 per ounce globally. But here's what's making investors watchful. This isn't simply another dip. The technical structure, the inventory data, the timing, everything is converging at once. And here's the kicker. Chinese markets are shut today for Lunar New Year. They won't reopen until February 24th. That's 8 full trading days without the world's biggest silver consumer. The last time we had thin liquidity like this with extreme positioning, silver plunged 37% in a single day on January 30th. But it also jumped 147% in the 12 months before that. We're at an inflection point, and I'm going to demonstrate you exactly what's occurring, what the data says, and what investors are monitoring in the next 72 hours that could determine whether we see a capitulation sell-off or the setup for the next explosive leg higher. If you want real-time analysis that cuts through the noise, hit subscribe, drop silver alert in the comments if you're tracking this with me. And understand something, I don't chase metrics. I'm here for the people who want to know what's actually occurring, not the sanitized version that makes everyone comfortable. Let's break down exactly what shifted in the last 60 minutes and why it matters. The price action nobody's talking about. Here's what the mainstream financial media isn't telling you. Silver simply hit fresh lows for February 2026. But the context of this move changes everything. As of this morning, Monday, February 16th, silver prices in India, which often lead global physical demand signals, fell to 2,74,900 rupees per kilogram. That's down 21.5% from the February 1st peak of 3.50 lakh rupees per kilogram. In dollar terms, we're looking at approximately $77 to $78 per ounce on the global spot market, but zoom out simply slightly, and the picture gets wild. 1 year ago, February 2025, silver was trading at $32 per ounce. Even after the severe 37% crash on January 30th that took silver from its all-time high of $121 down to the mid-70s, we're still up 140% from 1 year ago. Think about that. Silver plunged harder than any commodity in recorded history on a single day, and it's still up 140% year over year. But here's where it gets noteworthy. This morning's price action isn't occurring in a vacuum. It's occurring with 3 crucial factors converging simultaneously. Factor 1, Chinese New Year liquidity, black hole. Chinese markets shut today, Monday, February 16th, and won't reopen until Tuesday, February 24th. That's 8 trading days without China, the world's biggest silver consumer, biggest silver producer, and biggest speculative trading market for industrial metals. When Chinese markets are offline, liquidity evaporates, order books thin out. Any selling pressure that would normally be absorbed by deep Chinese buying interest instead moves price dramatically. We saw this exact setup in the days before the January 30th crash. The liquidity reduction created the conditions for the historic sell-off. Right now, we're in that same window. Thin liquidity, high volatility, maximum uncertainty. Factor 2, COMX registered inventory at crucial lows. As of February 13th, the most recent data available, COMEX registered silver inventories have fallen below 98 million ounces. Let me put that in context. In February 2021, COMEX registered silver peaked at 152 million ounces. We've declined over 80% from that peak. But here's the crucial detail. Registered silver is the only silver available for delivery against futures contracts. The rest sits in eligible category, meaning it meets exchange standards, but the owners aren't making it available for delivery. Total COMEX inventory is around 381 million ounces, but only 98 million is actually deliverable. And according to reports from the past week, that number continues to reduction. One day alone saw a 3.25 million ounce withdrawal from registered stocks. March delivery contracts, which begin first notice day on February 27th, simply 11 days from now, represent potential claims on 400 plus million ounces of silver. The math doesn't work. There isn't enough registered inventory to satisfy even 25% of those claims if they stand for delivery. The system is structurally short and the clock is ticking. Factor 3, Shanghai premium at $10 plus over Western spot. While Western paper markets are pricing silver at $77 to $78, Shanghai physical silver is trading with a premium of over $10 per ounce. That's a 13% premium for physical metal in Asia. Premiums don't exist in efficient markets. When Shanghai is paying $87 to $88 for the same silver that Western futures markets price at $77 to $78, it means one of two things. Either Western paper is underpricing real metal, or Eastern buyers are panic buying ahead of supply constraints. Given that COMEX inventories are draining, given that Chinese markets simply shut for 8 days, given that March delivery is 11 days away, I'd bet on the first explanation. Paper markets are mispricing physical reality. And when that gap closes, when paper price catches up to physical, it doesn't happen gradually. It happens violently. What happened in the last hour? Now let me tell you what shifted specifically in the last 60 minutes that has investors on watchful. At approximately 6 a.m. IST this morning, 7:30 p.m. Eastern Time Sunday night in the U.S., when Asian markets resumed trading after the weekend, silver opened with immediate selling pressure, not gradual selling, immediate. The technical levels collapsed fast. Support at 2.75 lakh rupees per kilogram in India. The previous February low collapsed clean. No bounce, no defense, simply straight through. The $78 psychological level in Western markets was tested and collapsed during Asian hours. That's significant because $78 had been defended multiple times over the past week. Volume spiked in the first 30 minutes of trading, not retail volume, but institutional flow. Large orders hitting the market in a coordinated fashion. This isn't random. This is positioning. But here's what makes it different from previous sell-offs. The physical market hasn't followed. Dealers in India report that buying interest has completely evaporated, but so has selling. The retail market is frozen. Nobody's buying at these prices, but nobody's panic selling either. That tells you this move is occurring in futures markets, not physical. And futures markets can be manipulated with leverage. Physical markets cannot. The 3 scenarios for this week. Based on the data, there are 3 potential paths. Silver takes between now and March delivery on February 27th. Let me walk through each one and the probability I'm assigning. Scenario 1, capitulation sell-off, 30% probability. In this scenario, thin liquidity during Chinese New Year allows shorts to press the advantage. They drive silver down to $72 to $70 per ounce, triggering stop losses and margin calls on over-leveraged longs. Panic selling accelerates the move. The key level to watch is $76 support. If that breaks with volume, we're heading to $72. If $72 breaks, we test $70, which was Friday's low during the January 30th crash. Why this scenario has lower probability? COMEX inventories are too low. Industrial demand hasn't weakened. The structural supply deficit is real. A move below $72 would trigger massive physical buying from industrial users who need the metal. It would also bring in sovereign buyers who've been waiting for a re-entry point, but it's still potential. Leverage and thin liquidity can override fundamentals in the short term. Scenario 2, grinding consolidation, 40% probability. In this scenario, we stay range-bound between $77 to $82 through Chinese New Year. No major moves in either direction. Shorts don't press aggressively because they're mindful of March delivery risk. Longs don't accumulate aggressively because they're shell-shocked from January 30th. This is the wait-and-see scenario. The real action comes after February 24th when Chinese markets reopen, and especially after February 27th when March delivery begins. The key levels to watch, $77 support and $82 resistance. As long as we stay inside that range, we're in consolidation mode. Why? This scenario has decent probability. Nobody wants to make big bets right before an 8-day liquidity hole. Risk management says to wait, but the lack of conviction could mean we're simply drifting until the next catalyst. Scenario 3. Short squeeze into March delivery, 30% probability. This is the explosive scenario. In this path, physical buyers, particularly Eastern buyers who see the Shanghai premium, step in aggressively. They buy futures with the intent to stand for delivery in March. As delivery demands increase, shorts, who are betting on price declines, realize they're going to have to deliver actual metal, but there's only 98 million ounces registered. If even 50 million ounces worth of contracts stand for delivery, the shorts have to either find physical metal or cover their positions by buying futures. That's a classic short squeeze. And in thin liquidity, with China offline, squeezes go vertical. The key level to watch is $82 resistance. If we break out and hold above $82 with volume, particularly if it happens before February 24th, that's your signal that physical demand is overriding paper selling. Why this scenario is plausible. The January 30th crash shook out weak hands and over-leveraged speculators. The people still holding long positions now are either industrial users who need the metal or conviction buyers who understand the supply deficit. March delivery is historically when squeezes happen and COMEX inventories are at crucial lows, the central bank buying. Nobody mentions. Here's something that doesn't get enough attention. While silver plunged 37% in a day, central banks didn't stop buying. In fact, they accelerated. According to recent data, central banks globally purchased over 1,000 tons of gold in 2025, one of the highest years on record. And while central banks don't report silver purchases the same way they report gold, the pattern is clear. Sovereign buyers are diversifying away from dollar-denominated assets. Poland bought 102 tons of gold in 2025, with officials explicitly citing national security as the reason. Kazakhstan bought 57 tons. Brazil re-entered the market after years away. And China, which stopped publicly reporting its purchases in 2019, is widely believed to be the biggest accumulator. Silver doesn't move independently from gold. When central banks bid aggressively for gold, industrial and investment demand for silver follows. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, currently sits at approximately 65 to 1. Historically, that ratio averages between 40 to 1 and 60 to 1. At current gold prices, around $5,000 per ounce. A 50 to 1 ratio would price silver at $100 per ounce. Even the current ratio at 65 to 1 suggests silver is undervalued relative to gold. Central banks are sending a signal. They don't trust paper, they want hard assets. And silver, as the most undervalued hard asset with industrial demand, is the obvious next move. What the data says about industrial demand. Let me address the elephant in the room. Is this simply a speculative bubble that popped, or is there real demand supporting higher prices? The answer is unequivocal. Industrial demand for silver is accelerating, not slowing. Here are the numbers. Solar panel installations globally are projected to consume over 200 million ounces of silver in 2026. That's up from 160 million ounces in 2024. Solar demand alone accounts for 20% of total silver demand. Electric vehicle production requires 25 to 50 grams of silver per vehicle depending on the model. With EV sales growing globally, this demand is structural, not cyclical. 5G infrastructure build-out uses silver in every base station, every antenna array, every circuit board. As 5G expands, silver consumption expands with it. AI data centers require silver in semiconductors and high-performance computing chips. The AI boom is a silver boom. Add it all up, and industrial demand exceeds 700 million ounces annually. Meanwhile, gold's global silver production is approximately 1 billion ounces per year, but 75 to 80% of that comes as a byproduct of copper, zinc, and lead mining. You can't simply produce more silver because prices are high. You have to mine more base metals, which depends on those markets' economics. The structural supply deficit is real, and it's widening, not narrowing. March 27th, the date every silver trader is monitoring. Let me explain why February 27th, 11 days from now, is the most significant date in the silver market this year. March delivery contracts on COMEX allow buyers to demand physical delivery starting February 27th. This is called First Notice Day. Between First Notice and last trading day, roughly March 27th, anyone holding a long futures contract can either roll it forward to a later month, close the position for cash, or stand for delivery and demand physical silver. Here's the problem. Open interest on March contracts represents over 400 million ounces of potential delivery claims. COMEX has 98 million ounces of registered inventory. The math doesn't work. Now, in normal times, the vast majority of futures contracts get settled in cash or rolled forward. Maybe 5 to 10% actually stand for delivery. But these aren't normal times. If even 25% of March contracts demand delivery, 100 million ounces, COMEX doesn't have it. They would have to either encourage shorts to deliver metal they don't have, forcing them to buy, spot, and deliver, or change the rules to allow cash settlement or extended delivery windows, or let the squeeze happen and watch the price go vertical. History shows that when exchanges face delivery squeezes, they usually change the rules. They did it with nickel on the London Metal Exchange in 2022. They did it with palladium in the 1990s. Well, they do whatever it takes to protect the shorts and prevent the system from breaking. But here's the thing. The world is monitoring. After the January 30th crash, where U.S. Treasury Secretary Scott Bessent publicly blamed Chinese speculators for the volatility, global confidence in Western paper markets is at an all-time low. If COMEX changes the rules to protect shorts in March, it won't simply be a market event. It will be a credibility event. It will confirm what Eastern buyers already suspect. Western paper markets don't actually have the metal, and when that confirmation happens, the Shanghai premium will explode. Physical will fully decouple from paper, and silver will trade in two separate markets. One for real metal, one for promises. What I'm monitoring in the next 72 hours. Let me give you my exact watch list for the next 3 days. These are the signals that will tell us which scenario plays out. Signal 1, volume and momentum in Asian trading. Monday night into Tuesday morning, U.S. time, we're in the heart of Asian trading hours. If we see sustained buying pressure, volume picking up, price stabilizing above $78, that tells us physical buyers are stepping in despite thin liquidity. If we see continued selling pressure with volume, That tells us shorts are pressing while China is offline. Watch the first 4 hours of Asian trading tonight. That's when we'll get the clearest signal. Signal 2, Shanghai Premium on Tuesday. Shanghai markets are shut Monday for Lunar New Year, but Hong Kong remains partially open. If the Hong Kong physical premium starts to widen, if it goes from $10 over spot to $12, $15, $20, that's your signal that Eastern demand is outstripping Western supply. A widening premium during thin liquidity is the precursor to a squeeze. Signal 3, COMX inventory reports. COMX publishes daily inventory reports. If we see another large withdrawal from registered stocks, anything over 2 million ounces, that's confirmation that the reduction is accelerating into March delivery. If registered stocks drop below 95 million ounces this week, March delivery becomes a real crisis. Signal 4, options positioning at $80 and $85 strikes. There is massive call open interest at the $80 and $85 strikes expiring this month. If price approaches $80, market makers who sold those calls will have to hedge by buying futures. That creates mechanical buying pressure, what's called a gamma squeeze. Watch how price reacts as it approaches $80. If it accelerates through rather than stalling, that's your signal that the squeeze is engaging. What this means for you, let me be very clear about what I'm not saying. I'm not telling you to buy silver. I'm not telling you to sell silver. I'm not giving financial advice. What I'm saying is this: we are at a crucial inflection point. The next 2 weeks will determine whether silver consolidates in the 70s, breaks down to the 60s, or squeezes back toward 100 plus. If you hold physical silver, my view is simple: do nothing. The volatility is in futures markets. Physical metal isn't going to zero. The industrial demand is real. The supply deficit is real. Ride out the noise. If you trade futures or options, you need to understand the risk. This is not an environment for leverage. Thin liquidity, Chinese markets offline, March delivery approaching. These are conditions where overnight gaps can liquidate positions before you wake up. If you're considering getting into silver, understand what you're buying. Physical premiums over spot are running 8 to 12% right now. That means dealers are charging $85 to $87 for metal that paper markets price at $77. That spread exists because physical is tight. Don't overpay, but also don't wait for paper prices to drop to $60. If you're buying physical, it might not be available at that price. The bigger picture. Let me zoom out for a moment because the silver story isn't simply about silver. It's about the entire monetary system. We're living through the end of a 50-year experiment with pure fiat currency. Since 1971, when Nixon shut the gold window, the US dollar hasn't been backed by anything except trust. For 50 years, that trust held. But it's breaking. Central banks buying 1,000 plus tons of gold annually. BRICS nations developing alternative trade settlement systems. Sovereign nations like Poland citing national security as the reason to buy gold. Shanghai trading physical silver at 13% premiums over Western paper markets. These aren't random events. These are symptoms of a system losing credibility. Silver and gold are the thermometers measuring that loss of trust. When the temperature spikes like it did in January when silver hit $121, that's the market screaming that something is broken. When it crashes 37% in a day like it did on January 30th, that's the system pushing back, trying to restore the illusion of control. But the fundamentals haven't changed. The debt is still exploding. The money supply is still expanding. The supply deficit in physical silver is still real, and the world is still slowly, methodically moving away from dollar hegemony. What happened in the last hour, silver hitting fresh February lows with thin liquidity and crucial inventory levels, is simply the next chapter in that story. Final thoughts. Something shifted in the silver market today. Whether it was the final capitulation before a bottom, or the setup for the next leg down, or the springboard for a March squeeze, we'll know soon. What I know for certain is this: the people paying attention right now will be positioned correctly. The people ignoring the data, dismissing the inventory crisis, trusting that paper markets reflect reality, they're going to get caught on the wrong side. I've shown you the data. I've shown you the scenarios. I've shown you what to watch. Now, it's your job to do your own research, make your own decisions, and take responsibility for your own capital. Silver at $77 after a 140% gain in 12 months and a 37% single-day crash is not a normal market. It's a transitional market, and transitions create opportunity if you understand what's occurring. Subscribe if you want real-time updates as March delivery approaches. Drop a comment if you're tracking this with me. And remember, the mainstream media won't cover this until it's too late. They didn't cover the January 30th crash until it was over. They didn't cover the 147% rally in 2025 until silver was already at $100. By the time they tell you what's occurring, the move is finished. You're hearing it now. Use that advantage wisely. This is not financial advice. Do your own research. Understand the risks. I am not a financial advisor.